Howdy, boys and girls. I got a request on my YouTube channel to go over it says here, can you do a video to explain the tax benefits of renting as an Airbnb before switching to pad split? Yes, I can. In 2023, I was employed until August. So my accountant had told me, hey, if you're employed for more than half of the year, even if you're employed at all through with a W-2, it shows up as kind of a red flag for the IRS if you try to claim real estate professional status. So there's another way to do tax incentive cost segregations through a short-term rental. They call it the STR loophole or short-term rental loophole. So what we did was we ran the property as a short-term rental. And by the way, I talked to my lawyer, just happens to be Mark Kohler. I've got some selfies with him because I'm a fanboy. But I talked to Mark about it, and he said, "Hey, look, what you should do is rent it out three times, and you can look up the code on this, but rent it out three times, uh, under 7 days, where you materially participate." And so if you do that plus the hour requirements, which I believe it's either 100 or 250 hours. I can't remember which. I spent way more than that on it, putting in the furniture, building in all the time invested in shopping for it, and blah, blah, blah. So if you do a short-term rental under 7 days average throughout the year and you materially participate, you can claim what's called the short-term rental loophole. So what that means is it's an active investment. Therefore, it matches up to your active W-2 income, meaning you can subtract the cost segregation from the property and write off that bonus depreciation. So what is bonus depreciation? Bonus depreciation is moving forward your tax incentives that normally would be taken over the course of time. If you want to dig into the details, Google it. Google the bonus depreciation and what's called a cost segregation. So the bonus depreciation I took in year one, and I did a cost segregation, and I used cost seg EZ, COST SEGEZ. Now, do what you do things at your own pace and talk to your accountant and your attorneys. But that I did leverage it, and I did buy the insurance with cost seg EZ. So typically people will go out and hire an engineer to come in and do an analysis where they're physically there. I chose to use the software CostSeg EZ that takes the average. And I did buy the insurance in case I get audited. Then they do apparently send out an engineer and do the actual cost seg. So now this is just what I did. Do what you got to do your way. I'm just telling you how I did it. So once they come through, they do the cost segregation is what I'm using for short there, cost seg. They'll come through, do the cost seg, however you do it, virtual or in person. And then based on that evaluation, you can write off a certain amount. You can't deduct the land and the bricks and sticks, you can't touch either for the bonus portion. But the roof is probably a 15-year write-off, 15-year roof. I believe it's I don't know, 5, 10, 15-year write-off points. It might be different denominations like 5, 7, 10, 15, I don't know. But basically, you can write off things that are going to wear out before the 27 and a half years, which the house, according to the IRS, will be worth zero. According to the IRS, if you bought a house and did nothing to it in 27 and a half years, it'd be worth nothing. But that's the way they're planning it. So 3.5% a year on that 27 and 30 years, it'll be nothing. So what you can do is you can pull it forward through bonus depreciation. I would Google it so you get a firm understanding, but essentially you can pull forward all those, that's tax incentives, the write-offs in year one, instead of waiting to write them off over time. So for example, like a refrigerator, windows, flooring, the roof's 15 years, things like that, you can depreciate in year one through bonus depreciation. You can do that regardless of having a W-2 or not a W-2 if you have a rental income property. But I wanted to try to get what would normally be passive income, meaning if I bought the house and made it a rental, then that would be 15% tax and passive income. Great. but I couldn't offset my tax burden from my W-2 with the real estate unless I made it active. The other way to do it is not have a job and just have passive income, and that way you're passive to passive, you can deduct it. But I have now I went back to work this year as well. So my wife is the real estate professional, and we'll be writing this off through her, right? So if you're married, you're a couple, then you can do that as well. So I hope that answers Michael Smith's 5463's question. He put it up on YouTube about 3 hours ago. Michael, if I didn't answer it or need to expand on it, let me know, comment in this new video. Thank you and have a good one.